Early in my investing journey, I was armed with books, the right mindset, or at least I thought, and diligently practicing dollar cost averaging with my savings. But I'll be real with you, there were moments when market news or commentaries would creep in and cast doubt.
We're going to talk about a rather serious topic, 2024, the recession. It's coming. Let's not pretend it isn't.
Meanwhile, economist Harry Dent is making a dire prediction about the market next year. He says 2024 is going to bring, and I'm quoting him now, the biggest crash of our lifetime.
When is the next housing market crash actually going to happen?
Move into next year, as that window continues to progress, you tend to find your way into a bear market that's eventually associated with a recession.
I'd wonder, am I on the right path? Should I buy out for a while? Maybe stash more cash or throw in some gold? It was a bit of mental tug of war, and in the midst of these uncertainties, I slowly uncovered the truth. A lot of those market predictions out there are crafted to grab attention. And selling fears is a classic move. But I didn't learn this by plugging my ears and dismissing everything that I heard. No. I learned it by doing some good old fact digging. So today, I'm sharing these 6 facts that I wish I had known right from the beginning. They've been the game changer, turning me into a more confident investor, and I hope they'll do the same for you. The notion that the stock market is too risky often keeps many from taking the plunge into investing. And I get it. We all heard horror stories about market crashes, the tech bubble in 2000,
after the dot-com crash,
the financial crisis in 2008,
I don't know. All of a sudden here we start,
and the mess the pandemic created.
A global pandemic will soon be declared.
And nobody wants to see their hard-earned cash disappear in the blink of an eye, right? So what do? Many of us stash our money in the bank thinking it's the safer bet. But here is the kicker. It might actually be riskier. And let me break down why in 3 simple points. First off, there's this sneaky thing called inflation. While your money is sitting pretty in the bank, inflation is quietly nibbling away at its purchasing power. Your stash might look the same, but in reality, it's losing value. And currently in Australia, the latest reported inflation is 5.4%. If we keep our cash in a savings account, the highest savings interest rate we can get is about 5 to 5.5% at the moment. At the end of the year, the interest we receive would just evaporate. What if we invest our money into the stock market, say a S&P 500 index fund? The average annual return of the S&P 500 has been about 10% since 1926. And this means after inflation, our money will be able to bring additional 4.6% return. The Australian share market has returned an average of 13% per year from 1990 to 2022. The magic of compounding in the stock market will make your money do some serious heavy lifting over time. And let's not forget about taxes. That interest you're earning in the bank, the taxman wants a piece of it.
Look, I received this in the morning mail.
Thou art hereby ordered to pay 12 pounds of gold, 5 shillings.
What you thought was a safe haven suddenly isn't looking so secure after all. Now, let's dive into reason number 2. It's all about losing your staying power by sitting out of the stock market. And Schwab Center did a deep dive. Sitting on the sidelines, even for short periods, can be a costly mistake. Between 1996 and 2015, the S&P 500 was delivering an average yearly return of 8.2%. Sounds sweet, huh? But hold on. If you miss out on the top 10 trading days during those 20 years, your returns would be slashed in half to 4% a year. It gets even worse. Miss out on the top 20 trading days and your annual return would plummet to 2.1%. Keep the top 30 and you're looking at a big fat 0. If you miss the top 40 trading days, you'll be in the negative 2%. That's the roller coaster you don't want to ride. And in case you're thinking, well, maybe that was just a crazy 2 decades. Let's fast forward to the pandemic year 2020. The S&P 500 had a total return of 18.4%. Now, picture this. If you sold when the market dropped, not only did you lock in your losses, but you might have also missed out on the best trading days. If you skip the top 10 trading days in 2020, you'll be staring at a hefty 33% loss. It gets worse. If you miss the top 40 trading days, you'll be looking at a mind-blowing 62% loss. Now, let's be real. Statistically, hitting all the market highs and dodging all the lows is like trying to catch a unicorn. Just not happening.
No, not gonna happen.
How about investing in the wrong time? And picture this, 5 different folks, each handed $2,000 at the start of every year for a solid 20 years, wrapping up in 2020. Now, you think the one playing it safe, sitting in a pile of cash, would come out on top, right? Well, surprise, surprise, is quite the opposite. Even the investor who decided to dance with danger, investing at the market's peaks every single time, outperformed the one who parked their cash in safety. It might sound counterintuitive, but the biggest risk in investing isn't the market's ups and downs, it's actually being out of the market. Timing the market perfectly is a myth, and waiting on the sidelines might just cost you more in the long run. So next time you catch yourself second guessing, remember, sometimes it's better to jump into the dance even if the music seems a bit unpredictable.
Never get out of the market.
Now, let's unpack the second fact that I wish I had known earlier. Market corrections are more common than we might think. But before we dive in, let's do a quick crash course on market lingo. We got market corrections, bear markets, and the ever-positive bull markets. A market correction is like a temporary dip in the roller coaster ride of stocks. It's a value drop of 10 to 20% from the recent peak. And the good news is it usually doesn't last forever. Corrections come and go, and they end once stocks regain their mojo and hit new highs. Now, here's where it gets interesting. Every bear market starts as a humble market correction. If the market takes a more serious nosedive and drops over 20%, then buckle up. You're officially in bear market territory. It's like the roller coaster suddenly deciding to go downhill for a bit longer. On the flip side, we got the bull market, the golden age for investors. This is when stock market indices are on the rise, climbing to new heights. It's like the roller coaster soaring to the thrilling peaks, and everyone is enjoying the ride. According to Yardeni research, from 1929 until now, we've seen a whopping 60 corrections. Nearly 38% of these friendly corrections decided to take a more extended vacation, transforming into bear markets. So crunching the numbers, on average, bear markets made a show every 4 years, and their smaller cousins, the market corrections, popped out every 2 years. But here is the silver lining. Every time we've seen a bear market rear its head, it's always been followed by a bull market. Now, let's debunk a myth that seems to persist in the investing world. The idea that you can predict the market's moves and sidestep its downturns if you're smart enough. We've all seen those confident experts from big banks making S&P 500 predictions as if they have a crystal ball. Spoiler alert, nobody can consistently predict the market correctly. Jeb Bogle, the founder of Vanguard, had said, "Sure, it would be great to get out of the stock market at the high and back in at the low, but in 65 years in the business, I not only have never met anybody that knew how to do it, I've never met anybody who had met anybody that knew how to do it." Warren Buffett has said, "The only value of stock forecasters is to make fortune tellers look good." Dr. Nouriel Roubini, aka Dr. Doom, he did successfully predict the 2008 financial crisis. However, before that stellar call, he had been calling for a recession every single year. In 2004, wrongly. 2005, wrongly. 2006, 2007, again, wrongly. Well, statistically, he had a 50% chance of getting it right. Fast forward a bit, and he incorrectly predicted a significant stock market correction in 2013. In reality, the market rose by a whopping 30% that year. And it's not just Dr. Doom. There are over 20 chief market strategists at Wall Street's biggest institutions. These folks aren't just smart, they have access to the latest and greatest information.
Because by the time you read about it in the Wall Street Journal, it's already too late.
But on average, their forecasts missed the mark by a staggering 15 percentage points per year. Yes, you heard it right. Percentage points, not percentage. So if the market actually rose by 25%, they might have predicted anywhere between a 10% rise to a 40% rise. That's a wide range. But what about Wall Street analysts, you'll ask? These are the folks diving deep into companies and industries, evaluating future prospects, and giving those buy, sell, hold ratings. Well, turns out their primary audience, the institutional investors, don't really care much about their stock picking skills. In the revealing book called Fool or Bull, a former Wall Street analyst with over 30 years of experience spilled the beans. Analysts, he exclaimed, rake in hefty compensation, often over $1 million annually, unrelated to the accuracy of their stock recommendations. Instead, their income depends on things like institutional client polls, overall eminence and influence, institutional sales, and, you guess it, investment banking deals. As he bluntly put it, their investment rating track record is not impressive at all. Now, how about the star active fund managers who tries to put a handful of investments that can generate alpha returns? Their fund's performance? Not so good. S&P Dow Jones Indices published semi-annual reports called SPIVA, comparing the performance of active stock and bond mutual funds against their benchmark indices. As of the data till 30th of June 2023, 92% of the active funds underperformed the S&P 500 in the US, 95% of the active funds underperformed the S&P TSX Composite in Canada, 81% of the active funds underperformed the S&P ASX 200 index in Australia. In Europe, 93% of the active funds underperformed the S&P Europe 350 index. In 2008, Warren Buffett placed $1 million bet with the hedge fund industry, which in his view charged too much fees that the fund's performance cannot justify. Hedge fund industries is also known to provide alpha returns above the average market beta returns. And Buffett's bet was that, including fees, costs, and expenses, an S&P 500 index fund would outperform a hand-picked portfolio of hedge funds over 10 years. In 2017, Buffett defeated the hedge fund, and the founder wrote, "For all intents and purposes, the game is over. I lost." Now, the big question, why do people still listen to these strategies, and why are they, let's be honest, not so great at their predictions? Well, it's a cocktail of office politics, conflicts of interest, and perhaps the allure of having someone guide us through the market maze. But one thing is for sure, relying on these forecasts as gospel might leave you scratching your head more often than not. Let's review the next fact. Finance is not rocket science. Well, it turns out we often approach finance as if it were a precise science, akin to physics or engineering. We crave the belief that financial markets can be measured cleanly and precisely, just like calculating the final velocity of an object in physics. In the world of physics, if you know the initial velocity, the acceleration, and the time duration, you can precisely calculate the final velocity. It's a straightforward, formulaic process. Now, transfer that mindset to finance. We want to believe that there are brilliant minds out there who can read the data, crunch the numbers, and provide us with an exact roadmap for where the S&P 500 will be tomorrow, just as we can predict the trajectory of a projectile. Take the free cash flow model to calculate intrinsic value, for example. There are many metrics that go into the formula that are based on estimations. It's a tangled web of estimations, and the final discount rate can end up resembling a wide spectrum. And this matches Heisenberg's uncertainty principle, which is a fundamental concept in quantum physics. It states that the more accurately one property is measured, the less accurately the other property can be known. And moreover, analysts are not immune to their own biases, and personal preferences or holdings in a particular stock can sway their judgments. And the bullish fair value they assign might just be the gust of wind needed to inflate the stock price. It's a dance between objective analysis and subjective perceptions, a concept explored by Nobel Prize winner economist Robert Shiller in his book Narrative Economics. In his book, he delves into how public perceptions can shape economic trends, revealing that human emotion plays a more significant role than we often give credit for in the seemingly objective world of stock, bond, and property valuations. In reality, finance is far from the exact science. It's a complex interplay of factors influenced by human behavior, emotions, and unforeseen events. And that was on the macro perspective of the stock market. If we zoom in to the micro individual investor, investing is about 30% technical know-how and 70% behavioral discipline. At the end of the day, it's not about who is the smartest person in the room. Understanding the technical stuff is crucial, no doubt, but the real magic happens when you can master the behavioral side of the equation.
And the key organ in your body in the stock market is your stomach. It's not the brain. If you can add 8 and 8 and get reasonably close to 16, that's the only level of math you need to know.
Now, let's chat about something crucial. The financial world is a wild ride of constant change. Let's look at retirement plans, for example, first. The trustee 401k is only 45 years old, born in 1978. Then there's his younger sibling, the Roth IRA, making its way in 1997. And here in Australia, superannuation system was only introduced in 1992. For most of the 20th century, Aussies were mostly banking on age pensions. So financial advice about how we save for retirement today is not comparable to the case just a generation ago. And trading? Electronic trading kicked off in the 1970s, but the real party happened in the 1990s and 2000s with the rise of the internet. And fast forward to today, we even have the options of robo-advisor and micro-investing. Even the mighty S&P 500 got a makeover. Financial stocks were not even in the club until 1976. Now they're holding a solid 14%. Technology stocks were virtually non-existent 53 years ago. Today, they take more than 30% of the index. The index fund revolution, thank Vanguard's Jack Bogle, who dropped the first one in 1976. The first index ETF, it only came onto the scene in 1993. The rise of index investing has been insane, and we're talking about $11 trillion globally today, and compared to just $2 trillion a decade back. Things changed. Things worked before might not be able to provide effective guidance for now. Now, let's talk about the last one. Fees matter. The US Securities and Exchange Commission, or as we know it, the SEC, these folks are the watchdogs responsible for keeping an eye on the security market and ensuring retail investors don't get the short end of the stick. And they've done a research by studying the impact of fees and expenses on our hard-earned portfolios. Imagine tossing $100,000 into the investment arena and letting it tango for 20 years. The total hit for a 1% annual fee would be a whopping $28,000. If we invested that $28,000, you would have earned an additional $12,000. If we look at the graph, the green line is the portfolio value with a 1% annual fee. Now, compare that to the blue line with a more modest 0.25% annual fee, and the difference is nearly $30,000. For any ongoing management fees, Yale University researchers said that anything above 1% is a ripoff. In America, 401k fees can range between 0.5% to 2%. The average annual fee charged by most funds is 1%. For Australia's retirement fund superannuation, according to CanStar, the average Joe or Jane in their super fund's default investment option is parting between 0.91% and 1.21% of their account balance each year in fees, which is way too high. This is why it pays to roll up your sleeves and compare retirement funds, hunting for those low-cost investment options rather than settling for the default plan. Outside of retirement funds, the average ETF management fee is about 0.55%. However, the rock bottom fee for a broad market index ETF, it could be as low as 0.03%. Now, that's a game changer. So these proves that fees do matter. Alright, there you have them, the facts that have made me a more confident investor. If you're curious about the investing mistakes that I've made before, check out this video. My name is Irene. I'll see you next week. Bye.